here. We are back here with another video. I'm your host for Stocks for Hope, Dlamini. So today, guys, we're going to be speaking about what is a PIP value in Forex. What is a currency PIP value? But firstly, we're going to discuss what is a PIP and then discuss what is a lot size, because those two go together in order to count what is a PIP value. So guys, remember to like, subscribe, share and comment on our videos, guys, so that we get your feedback and so that you guys let us know on what you think on our sessions. So guys, remember that as well, these videos are mainly for educational purposes, not investing or trading advice. So any losses or profits made from these videos, Stocks for Hope and I myself will not be liable for any of that product. So remember that do not trade money you cannot afford to lose. So like, share, comment and please subscribe on our channel and click the ring button so that the next time when you upload a video you will get first-hand notification. So guys, what is a PIP in Forex? So we oftentimes talk about PIPs. We always see people on social media, they made this how much PIPs, they did this how much PIPs. So that let us try to put what is a PIP in simple terms, and that maybe other people will try to understand. So by definition, what is a PIP? A PIP is an acronym for percentage in point or price interest point. So a PIP is a small whole unit price move that an exchange rate can move based on Forex market conversion. So most currency pairs are priced out of 4 decimal places, and a single PIP is in the last 4th decimal place. So a PIP is thus equivalent to 100 of 1% of or something like a 1 basis point. So for example, the smallest whole units of the GBP USD currency pair makes close to 0.001 of a tenth of a percent, sort of 1% of the whole currency of a letness. So it's called a 1 basis point because it's the last 4th decimal number after the comma. So to make a simple example of what we just spoke about here, so let us make an example with Euro USD. So as we can see here, Euro dollar is the one that is on is displayed here. So the euro is the one which is the base currency. The dollar, it is the core currency. So the price that is displayed here, the 1.1051, it's the amount that you will pay to buy 1 euro. So this is the price that you will pay in dollars to buy 1 euro. So in all this, a PIP, we said, is the last 4th digits after the comma. It's the last 4 digits after a comma. So assuming if all these were zeros, this was 0.0001, this would be the last 4 digits after a comma. But in this case, they are numbers here. So we're just making a simple example now. We'll just go a little bit more into this now. So just to give it a more detailed name. So Forex currency pairs are quoted in terms of pips, short for percentage in points. So in practical terms, a pip is 100 of 1%. Okay, we just said that just now. A pip is equivalent. So we often hear about basis points most of the time when they talk about interest rates on the news. So a PIP is not an interest rate, but some sort of an example of the last decimal number that we hear when they talk about basis points. So if we can practically do another example that we see on live brokers when like markets are actually displayed live on the charts. So in actual PIP, like let's have make another example on GBP USD. So assuming that this is GBP USD quoted on the currency pair, so you would see that the left side, the number that is on the left side is the one that you click when you want to sell the currency pair. The one that is on the right is the one that you click when you want to buy that certain currency pair. Okay, all right. So this one is GBP USD. So if you want to buy GBP USD, you'll pay 1.3536 dollars. And then if you want to sell it, it's gonna be 1.3537 dollars. I know that there is another number that is here, but in this case, let us not talk about that number. So it has its own name. So let us not talk about that number now. So the difference now from 6 to 7 is what? It's 1 pip. So right now in this case, in order for you to execute this trade, you will pay the broker a spread of 1 pip. So the spread is the difference between the buy and the sell price. Okay, we've now spoken about a pip, now speaking about a spread. That is, a spread is a difference between the buy and the sell price, right? Now let us talk about lots, because we said these things, they go together and they meet each other at some point. Okay, so a lot is by definition is 100,000 units of the base currency. A lot is 100,000 units of what? Of the base currency. So remember that when you're trading forex, we trade currencies in pairs. So the base currency is always the one that is on your left hand side. So this is the base currency. So a lot is the 100 units of the one that is on your left hand side. Okay, so let us make an example of what is a lot. So basically there are 3 main lot sizes that we normally see on our platforms, or that we normally see even when brokers they talk about, even when those guys on CNBC they talk about, we normally talk about those 3 main lot sizes. So firstly, the biggest lot is a standard lot, which is 100,000 units. So on our MT4 platforms, those ones that are using an MT4 platform, a 1.00 is a standard lot there. Even on any platform, 1.00 is a standard lot. Then a mini lot, it's 10,000 worth units of the base currency, which is 0.10 lots there, which is the volume. So a micro lot is 1,000 units of the base currency, which is 0.01. Okay, remember that we said that these things, they go together. So now let us get into our discussion that we wanted to talk about here today. So a standard lot scale now, if we are opening a standard lot position on your platform, let's say you are going to buy GBP USD. So if you open a standard lot position, 1 pip move from one point to another point will cost you a straight $10, right? Then a mini lot, which is 10,000 worth units, which is 0.10, will cost you a $1 So a micro lot, which is 1,000 worth of units of that base currency, which is 0.10 in volume, will cost you a 1 cent there in dollars. So it cost you 1 cent in dollars. Okay, let us move deeper now. So The ones that I just mentioned now, that if you open one lot of that base currency, it's when we are talking about mostly when the base currency is when the codes currency is the US dollar, right? The base currency can be another currency, but if the codes currency is the US dollar, that's where this actually happens. If the standard lots, 100 units worth, you buy a standard lot, the 1 pip move will be a straight $10. So if we look at this list right here, Euro USD has a base currency of a euro, but a codes currency of the dollar. So it means that if you want to buy a single standard lot, 1 pip move will cost you a straight $1 US. Again, on this one, GBP USD, this one, a 1 pip move will cost you a straight US dollar again. But in this case, the US dollar is the base currency, then the code currency is the JPY. So in this case, it will not cost you that one, that 10 US dollars. So again, on USD CHF, this case it changes, and then on USD CAD again, this case it changes, and then Aussie dollar, the base currency is an Australian dollar, and then the code currency is US dollar. New Zealand dollar, the base is the New Zealand dollar, and then the code currency is the US dollar. Okay, I'll just explain something else just now. So the ones that you saw there that are not quoted by in dollars, so they can be another base currency and then the code currency, and then the code currency is not in dollars. So most of those pairs are called cross currency pairs. So let's make an example. Euro GBP is a cross currency pair. So CHF JPY is a cross currency pair because there is no dollar codes currency. GBP AUD is a codes currency because it's a GBP and the Australian dollar. So there's no dollar currency that is there. So it cannot give you cannot calculate it like this. You cannot calculate it like this when you buy 100,000 worth of it, which is a standard lot. It's a 1 pip move will cost you $1. You cannot calculate it like this. We'll just get into how to calculate it. I'm just making an example that how to actually do this thing. So how do we actually calculate the PIP value now? So we've learned about the PIP itself, and then we've learned about the spread. We've learned now about the lot size, and lastly we had learned about which currency pairs are quoted and marked. When you buy a certain currency pair, it will cost you a $10 for a standard lot. When you buy the currency pair, it will cost you a $1 for a mini lot, and then the list goes on. So those ones are for the ones when the dollar, it is the code currency. Okay, right? So how do we actually calculate this? So let us make an example where the base currency is the GBP, and then the code currency, it is the US dollar. So this one here, GBP USD, which is cable, a widely traded currency pair around the world. So let us say you want to buy, no, rather you want to sell GBP USD. You want to sell GBP USD. Let me just correct this. So let us say you want to sell GBP USD at a price of which is 1.2642. So the price of which is 1.2642, 1.42, let us say it is somewhere around here, right? This is where you want to buy the GBP USD. Okay, let us mark this level. So you want to sell at this 1.42 level. Remember guys, we said we are not counting the last digits now. We're only gonna deal this one point with the 4 digits after the comp. So and then our stop loss, it says there, is at 1.2260. So our stop is at there 1.2260, and then our target there, which is our take profit, is 1.2212, which is somewhere around which is somewhere around here. So you sold here, and then GBP USD fell, and then your target was hit eventually. So your risk was what? You sold it 42, and then your stop was at 1.260. So your risk was what? Was 18 pips. 42 minus 60. 42 minus 60, yes, is 18 pips. And then your reward from 42 to 12, it's what? It's 30 pips. So the risk reward in this case is 1:2, which is actually not bad. Which is just modest. You wanted to lose, let's say you wanted to lose this trade you open with just an $10, and then if your trade goes in a direction, it made $20. But now let us calculate the PIP value itself. So there's just so many calculators that are out there. So by now I'm just gonna make an example with this one, because I use this broker a lot. I've been using it for quite some time. So let us assume that our leverage is at 1:500. So our leverage there is at 1:500, and then obviously we're going to quote this in dollars. Okay, let us just say we're just going to do a straight standard loss. Now we said the straight standard loss is 100 worth, so which is the volume is going to be 1.00. So it's 1.00. So now I'm just going to put 1 basing a calculator. Calculate. Eventually, this calculator will just give me a straight answer that what is the PIP value that is needed here. So okay, I forgot to change here, guys. I'm sorry. The currency pair that we want is GBP USD. I don't know how I forgot the GBP USD. So the currency pair that we are making an example of is GBP USD. Okay, let's calculate again. Okay, so in this case, the margin that you're going to pay for this trade is going to be $251 US. So you've got to have this amount in your account. Okay, so our PIP value here, guys, is 10. Remember our risk reward. What was our risk reward? We said our risk reward was 18. Our risk was 18. So let us multiply a straight $10 to that $10 times 18, which is $180. So if this trade went against you in your account, you would have lost $180. But if this trade went in your direction, you could have made $300, which is 10 times 30, which is $300, which is you could have made a killing on this. You could have made a killing on this trade. But if you can change this thing, the lots, and make it a smaller one loss, in this case, you know what's gonna imagine the PIP value, it changes. The margin now is only $25. It's almost a quarter of what was the 250 was. But now the PIP value now is, it says $1. So $1 times 18, it's $18, which is your risk, your risk, and then the reward 1 times 30, which is you could have made $30, which is just not bad, or which is just modest. So for people who have smaller accounts in this case, so we add another 0 and then a 0.1. This one, it is the smallest lot size. Remember, it's 100,000 and then 10,000, and then this one, it is 1,000. So if we put another 0 and then you calculate, we remember we said that the market is only gonna go 1 cent, of which it's not bad. You risk $2, and then you could have made around about $3 on this trade, of which is just good. For people who have small accounts, please stick to these small lot sizes. You can even just change this number to 5, so you know that your margin was $12 on a 1:500 account, but now 1 point will move 5 cents, so the game changes now. So it's going to move 5 cents more. So that's $3 you could have made on this trade. Now you could have made $15, because now you're going to, it's 3 times 5 is going to be $15. I hope, guys, this makes sense to you, but this is just an educational video. You can just even try to find out more information on it. So remember what I said, that cross pairs usually have a different PIP value. So Euro GBP, in all of them, it has the highest PIP value. In all the currency pairs, it has the highest PIP value. The highest PIP value of Euro GBP, you're going to see it when you look at the calculator. So Euro GBP has the highest PIP value of all of them. So let us make an example here again on Euro GBP. So let us assume Euro GBP, you could have bought Euro GBP right here. You bought Euro GBP at 0.850, which is somewhere around here, and your stop loss SL was at 84.85, so which is somewhere around here, which is it's the previous low. This is a stop loss. You see good scanner from 850 to 84.85, your stop loss, which is 15 pips, which is not bad. And then your risk again, it's 30 pip. Again here, the risk is also 1:2. So if you go and calculate Euro GBP, let us change here. So Euro GBP, we still got the same settings. 1:500 leverage, standard account, and then our account currency is US dollar. So let us see how much is the PIP value. You remember that currencies that have a dollar code currency, they have a PIP value of 10. All of them. The ones that have a dollar base currency, sorry, that have a dollar code currency, all of them have a 10 PIP value. But look at Euro GBP, it has a PIP value of 12.5 for a standard lot. So for a micro lot, it's 0.1. It's 1.2. It's 1.25. And then for the smallest lots, the 0.01 lot, it's 0.1.25. Okay, if we could just do here, let's do USD JPY. So you see USD JPY has a base currency of a JPY, right? So there is a base currency of the US dollar and a code currency of the JPY. So you'll just see that the P value will be a little bit smaller than the others. Standard lots for this P value, you see, it's 7 for USD JPY. And for USD CAD, PIP value, it's 7.9, almost $8. So for another one, let us say a Euro AUD, PIP value of Euro AUD is 7.190. You see that these things, they changed because these ones now are cross pairs. The base currency is the euro and then the code currency is the Australian dollar. So now the PIP value is lower than the ones that are quoted with the US dollar. So guys, I hope you understand what we are trying to say and do here, because once you know how to calculate these things, you will be able how to calculate your risk and reward before you actually enter a particular trade. So I hope this video, guys, will be educational. Please be patient with me now, but I will try to make these videos more welcoming, and in future also please like, subscribe, comment and share our videos, guys. Remember, this is not educational, this is only for educational purposes, not trading or investment advice. So I hope you guys enjoy this video. I'll definitely see you on the next video. So thank you, and of course God bless.